Welcome to Telltales. I'm Mike Nicoletti. Every week, along with my co-hosts Jason Wallace and Hunt Lawrence, we bring you the cash flow memo. Get it at telltales.us. For the next 30 minutes, we're going to dive deep into energy, technology, and healthcare. So download the memo now and get started.
Let's start. And Exhibit C is interesting this Wednesday, I think, because given the Iran war and the impact, I made some changes to crude supply here. Interestingly enough, the crude supply in 26, this estimate, is somewhat less than 25. The demand didn't change. The demand is up very marginally by only 400,000 barrels. But the supply is off by about 500,000 barrels. And as compared to being up about 500,000 barrels in the prior numbers, the changes were to take U.S. production from 13, down from 13.3 in 24, up to 13.5, to hold the Saudis at 9.5 rather than 10.1, to bring Russia up a little. So they're relatively modest, bring Iraq down a little, bring the Emirates down a little. So really what's happening here is pretty modest changes. That's based on the beginnings of a conviction, I'll say the beginnings of a conviction, that we will be back to normal, something that looks like normal in the Straits of Hormuz by May. That doesn't necessarily mean a resolution with Iran. That means that all sides kind of stand down. That's probably an optimistic assessment for the rest of our capital markets. I think everyone I've tried that assessment on thinks it's quite optimistic. But I think at this point, it is the right assessment. We turn to Exhibit B. Last Thursday, the prompt price was 96. The 26 price was 80. That's more or less where the 26 price is now. I think that a reasonable expectation is that 27 price, rather than falling off to 74, which is the backwardation, which we can expect to see, that the 27 price is going to be less than the 26 price indefinitely. But I think a reasonable forecast for oil pricing in 26, 27, and 28 is around 80. Now, during the year, if that's the average during the year, it'll vary between 70 and 90. I mean, we'll get at least a $20 spread. Why won't it go down? Why won't we have oversupply again, where $60 is headed to 50? I think it's several things. One, the damage done to fields by Iran's sending missiles and drones and whatnot towards oil production facilities and oil export facilities. A more important part of it, I think, is that the nuclear situation in Iran is going to be left as is. I think it's a reasonable expectation from a trying to judge capital markets and investments and whatnot that Israel and the U.S. in 12 or 18 months, Iran will make more progress on nuclear, and the Israeli jets and missiles and U.S. jets and missiles will be back attacking those facilities. At that time, the attacks may be like last June, where it's 12 days or maybe less, and maybe Iran does not start closing the strait or firing missiles at at other oil export facilities. But there's going to be that uncertainty. And I just don't see in that uncertainty the price of oil going, measured by WTI, going back to 60. The way to think about oil is there's a intrinsic value that's determined by supply and demand. That intrinsic value was certainly headed towards 50, but then there's a risk premium. I think with the likelihood that the war in Iran is going to be left kind of unsettled, I think that risk premium will continue to be high, really, as far as anyone can predict, any reasonable prediction. So if we get to Exhibit A, U.S. government revenue and expenses, we are pretty insulated. We produce as much oil as we use. We produce more gas than we use. I don't think this has any impact on our national accounts, which is what the Exhibit A is, a cash flow statement for the U.S. government. Could revenue be a little less because there's a recession? Yeah, possibly. But I don't even think this is going to cause a recession. A recession, the definition of a recession is 2 straight quarters of real GNP decline. I don't think that's going to happen this time. So I think Exhibit A looks good. I think, and I say it every Wednesday, I do believe that I think it's a reasonable expectation that the deficit's going to come down. Now, it's still going to be too high. It's going to be $1.5 trillion rather than $1.9 trillion, but I think the trend is established. I think the trend will continue into 27 and 28. A fair criticism of that stance is defense spending at $900 billion will be higher. Now they're going to ask for a $200 billion supplemental to pay for Iran and to restock and so forth, their missile inventories. They'll get some additional money, but I'd be a little surprised if this Senate and this House passes that much. I think it'll be 100. Would that mean that for this year, the defense spending's more than 900? Yeah, 50 billion more, but the Republicans, the right side of the political spectrum is going to insist on pay-fors. What that means is if we're going to add money, we're going to deduct it somewhere else. And I do believe this administration, more than any other prior administration, is starting to make progress on healthcare costs. And healthcare costs, other than defense and interest, is the largest component of federal spending. I think they will continue to make progress on healthcare. So call me an optimist, but that's my view. Now, before we get Mike and Jason's comments, I just want to turn to the energy pages, and these will get updated for year-end results in the next couple of weeks. But and obviously there's been some improvement in prices across the board. The large companies, some improvement in the midstream companies, some improvement in page 11 on the oil companies. A judgment that I think will stand up is one of these, say these 5 companies on page 11, EOG, Magnolia, Permian Resources, Diamondback, and Matador, what oil price are they discounting? I think they've lifted enough so they're not discounting $60 on its way to 50. I think they're probably discounting 70, a full $10, I would say, under that. Will they ease up later this year and next year if oil starts averaging 80 rather than 70? I think so. Will they spend more than their cash flow the way the tech companies are to have enough compute to handle inference, AI inference? No way, no how. They're going to just spend half of their cash flow. Will they have more unit production growth because they have more cash flow to spend? Maybe a little, but it'll be hard to notice. So That's my take on the gas companies, which is page 12. In a weird kind of way, gas is going to be hurt by oil being high because the main source is gas production. Increased gas production is the Permian, associated gas. So the higher the oil price is, the more gas gets produced. And that's certainly causes, I mean, the hub out in West Texas, Waha, trades at a negative number. There's more pipe capacity coming, so that should clear up for a while anyway. But that increased gas production is going to retard gas pricing. With some of the Qatar LNG capacity down, you say, why doesn't that impact U.S. gas prices? It'll help, but it takes a long, long time to build LNG facilities. And I mean, like 3 years from start to finish. Maybe venture does a little quicker. Maybe venture does it in 18 months or 24 months. But it will it help demand for gas? Absolutely. But will it make a significant difference in terms of the price of natural gas next year or the year after? If we go back to Exhibit B, the forward strip is like 370 for 26 and 390 for 27. I think those are reasonable estimates, but they're not. It's as likely to move down from there as to move up. So I think if you're adding to positions or deciding what to hold on to, probably better at this point to add a company that's producing mostly oil. Now, all oil companies produce some gas, but the difference is that, on a BTU basis, the oil companies, EOG and the others, are way more than half oil. And as compared to the gas companies, they're generally way more than half gas. So, Mike, Jason, I've spent entirely too much time on exhibits A, B, and C, and page 11 and 12. Any other comments from a macro point of view?
There's a few other commodities that are at least worth mentioning that are affected by this war. One of them is helium, which is very important for the production of semiconductors and a bunch of other specialized things. 35% of the world's supply is now offline because it's produced in Qatar. And then there's also some fertilizers and whatnot that are sourced from there. So there's some additional things beyond energy that this will have trickle-down effects on, not to mention that the sustained higher oil prices will have an inflationary effect on quite a few different products as well.
I was actually going to bring up helium as well. So it's an input to MRI machines. So it's driving up the cost of operating MRIs. The new generation of MRI machines have a closed loop helium circuit. So it's not a consumable resource, but there's few of those installed right now. So most of the install base is actually consuming helium.
I think the good thing to do now is to focus on the first 4 or 5 pages. These are the companies that have led the stock market higher, the Mag 7, however you want to define it. I always like to leave Tesla out, is a high portion of our index. I don't know, 45% of our index. I believe that these companies are awfully well situated because Mike and Jason just mentioned inflation, helium costs, other things. These companies look pretty invulnerable to me to any kind of inflation pressure. They are spending a great deal, but the growth of inference on the language models, going from training to inference, has taken off in a way that we're all going to be impacted. And I think the decision makers at Microsoft, at Amazon, at Google, at Oracle, I think have made a correct assessment of how much capacity they need to cover the inference requirements. Now, once again, that may be too optimistic a view. So to give you the counter for that, or, I think we ought to get Mike and Jason for a few minutes to comment on how insulated these companies are from capital market distress caused by macro things like the war in Iran and increased inflation, et cetera, et cetera. So over to the two of you. I've taken entirely too much of this 30 minutes already. So over to you guys.
So I guess at a high level, technology companies are generally extraordinarily deflationary. And so any inflation effect would be a minor bump in the road as things move down the cost curve. Obviously, they are very dependent on purchasing semiconductors and becoming more capital intensive than they have been in the past. But you look at the cost per token, and we've gone from in the early days was it $30-something per million tokens, and now we're down in the pennies per million tokens. So we've come a long way in a really short period of time. And the innovations keep coming. Maybe, Jason, do you want to talk about the Turbo Quant?
Yeah, so yesterday, Google Research released a new language model called Turbo Quant. A year ago, this was a research paper. And in that 12 months, it's been developed, trained, and tested against benchmarks. So what this new model does is, without sacrificing any performance, it's not a improvement in performance that from the old models, but it reduces the size of the KV cache by 6 times. So the KV cache is essentially the memory constraint for a lot of these models. So you trade off having to compute a lot of calculations over and over again by storing that calculation in memory. The size of that grows exponentially as you put more input tokens into your context window. I know there's a lot of jargon, but the size of the data that you're giving the model to then make its inference. So,
which I would say is directly related to the amount of intelligence that a model is able to infer.
Right. So essentially, at the highest level, the memory constraint is a sixth of what it was by using this new model. So a couple implications there is, one, memory was probably the biggest constraint of why these models cannot go onto your iPhone or some other edge device. That hurdle is a lot smaller now. So we're a lot closer to having these models be able to run locally and not need the cloud. And the flip side of that is you could have a 6 times larger context window. So that means 6 times more data loaded into the language model that it can then use for inference for the questions that you ask it. So that we're a lot closer to essentially the models having this memory of all interactions they've had with you.
I would say that we're continuing down the curve on the pace that is relatively expected. And actually, I think the innovations from this model have already been implemented, for example, at Anthropic, who, 2 weeks ago increased the context window for Opus 4.6 from 200,000 tokens to 1 million. Mm-hmm. So, they gave away 5 and kept 1 for themselves.
Right. And in Google's, as their normal practice, they release these research papers publicly. So all of the other AI labs are reading them and making the same innovation.
So other companies on this page, Apple's business it will be really interesting to hear the next quarter's earnings when the explosive growth in Mac Mini sales occurs. It might not really move the needle at Apple, but those Mac Minis are actually quite old architecture and probably very profitable products to sell. And many of them are sold out pretty much everywhere.
But why is the Mac Mini popular? It doesn't have a super powerful GPU.
No.
It's the CPU in there. The intensity, the need for more traditional compute is going up exponentially as these agents have been released. So you need some sort of kind of traditional software application that manages all of the calls to the language models, figures out how to route them, how to interpret the results, and what actions to take. So we're actually seeing the CPU compute demand increase pretty dramatically now as well.
The CEO of ARM says that the average accelerated data center CPU usage is increased by 15 times as a result of agentic usage.
Yeah. And we saw in Intel's last earnings call, they said they sold out a particular line of CPUs and they didn't have the production capacity to meet demand. I think that's kind of a near-term thing. I think in the long term, Intel, AMD, anyone running x86 kind of loses out in the long term. I still think x86 essentially goes away. All of the hyperscalers are building their own CPUs. NVIDIA has developed a CPU that they're selling standalone. All of these are ARM architecture. So we're really seeing ARM supplant x86 right now.
Yeah. Yeah. The other thing to point out, because NVIDIA did come up with their own CPU, which some people might have thought was surprising, but it had a very specific purpose in that it's a single core CPU. And your modern CPU from AMD or this new one from ARM is literally hundreds, some of which are virtualized CPU cores. So that single threaded performance is very important for a particular task within a data center. And that's where these things have gone. I think, we've been talking about NVIDIA for a long time on this podcast. And at one point, the story was just NVIDIA's GPUs and the software ecosystem around it. And in the last couple of years, it has evolved dramatically from there to the point where they are selling essentially entire data centers. And yes, the software package around it is huge, but the playing field is very different in that you have lots of well-resourced players, and their competitive advantage has shifted from just a network effect to what we call process power. So their pace of development is what determines their ability to command the margins that they do. And the last GTC was representative of their ability to do that. And just looking at all the different types of chips that they've brought into the system, again, going from just a GPU to now all of this other stuff that basically serves the purpose of making sure that GPU is humming 100% of the time.
Hey, Mike, just let me interject. Do you and Jason think that NVIDIA will earn the same margin on this other equipment as they do on the GPUs?
Yes, because it's all kind of one package. Yet there are some instances where people will buy maybe they'll buy just that single-threaded CPU from them. I don't think they have any reason to charge less. And their ability to charge those prices is wholly dependent on their product being better than the competitors.
We can't ignore healthcare, Jason.
Yeah, there was an interesting story out of Australia, I believe 2 weeks ago, where a tech entrepreneur has a dog that has cancer, and it was given a very short time to live from diagnosis. What this well-resourced individual was able to do was have the tumor cells biopsied. He assembled a team of scientists to help him do this, but notably what the media picked up on is he heavily leaned on ChatGPT. And so the AI helped him identify the sequences of genes that were mutated to cause the cancer in the dog. And then he had a scientist create an mRNA vaccine to trigger the immune system to attack that tumor and treated his dog. And his dog did not completely clear the cancer, but it greatly improved his quality of life and lifespan. So I think one thing he said is the dog was very lethargic and went to, in just a couple of days, jumping over the couch or something like that. So it's really interesting. It's kind of it's an N of one, but it's a proof point of validation that these cancer vaccines are working. In addition to the studies that Moderna and BioNTech are running right now. Have we discussed the povetacicept Vertex results? I don't think so. So Vertex released some interim results from a phase 3 study of povetacicept, which is one of their drugs that treats a number of kidney diseases. This one's primarily affects men in their 30s and then ultimately results in kidney failure. There's limited treatment options for it, but The phase 2 data looked extraordinarily strong, and it was good to see that the phase 3 data largely matched up with that, especially because the phase 2 had a low dose and a high dose. The low dose was seen as just as effective. So the phase 3 study only tested the low dose. So they saw the same full effect from the low dose and had very few side effects because it was the lower dose. Other things is we're seeing an interesting story develop out of Harrow around insurance reimbursement and pricing. You know, they're very vocal that they have a fallback plan. Harrow has a fallback with a $59 out-of-pocket expense for their VEVI dry eye medication. At the beginning of the year, CVS picked that medication up on its PBM formulary, made it the primary first choice, and we're starting to see what reimbursement looks like for the patients that are being prescribed. And we've seen numbers around 734 was kind of what fell out. It's just very interesting that Harrow is willing to sell that drug direct to a patient for $59. And then you have the insurance billing at $734. So that just highlights what's going on in our system.
Good. What do you believe is going to go on with BioNTech, with the two founders leaving to set up another business? I think Mike might have answered this last week in saying that they wanted to work on the very early stages, where BioNTech was they were going to work on things before you even got to a phase 1 trial. Is that a fair way to think about BioNTech, that BioNTech will have a life beyond the two founders not being there?
Oh, absolutely. I think they're well positioned. Maybe down the road, and this is maybe a decade down the road, but because it takes so long for early stage research to make it this far, I think maybe there's a lull there where they see not having these two founders had a big impact. But I think where they are right now, there's so much in their pipeline that's late stage study that they need to push that over the finish line. They need to commercialize it. They have to negotiate with all the payers on who's going to pay for it, how much it costs. That's a lot of work that is not, drug discovery and lab work. So I really feel like my impression was they I don't know if the right word, but they're tired of doing that kind of work and dreamed of the days where they can go back in the lab and start discovering new compounds that might cure diseases. And I think that's what they did. And the business has changed a little bit. They acquired a lot of antibody drug conjugates with the money that they got out of the COVID vaccine. So it's not just their sole vision of mRNA cancer therapies. So they have a big line of other type of cancer drugs now too.
And the thing, this is probably a rational capital allocation decision too, because if you have founders that really just want to do really early stage research, knowing the cost to bring a drug to market, and then you have founder, influence and control on a large public organization, there's a mismatch of what a rational capital allocation decision is. Right now, the company needs to figure out how to take the assets it has and start generating cash flow. Pouring a bunch of money into early stage trials is basically buying lottery tickets. And the worst case scenario is you don't have an outsider to validate that what you're doing actually makes sense. So one of the things we look for when we see a company that's in this position, we really like it if they spin out company or the product into a separate entity and bring in VCs to raise a portion of the capital. So they contribute the IP, maybe they contribute a handful of employees to the team, and have third-party VCs validate the technology and put up capital. So that way you don't end up in, this yes man situation. And, when you're the founder of a company like BioNTech, not a lot of people are going to be saying no to you. So I think I think actually in some ways this is very rational, especially considering they're not cash flow positive today.
Interesting. Who else, Jason, in addition to Moderna, is doing cancer vaccines? Along with the BioNTech.
I don't know that anyone else is really far along on that path.
CureVac. But I think those two are the farthest along because they've had the capital.
Yeah. Jason, if you just in the couple of minutes we have left, if you had to evaluate the effort against cancer, how much of the potential result would you give to the cancer vaccines as compared to other cancer therapy?
Oh, to quantify it, a third. I'll give it a third. And the reason I say that is I think there's three things changing all at the same time that's going to reshape a lot of how we manage the treatment and monitoring of cancer. And there's a new generation of therapies like these antibody drug conjugates, bispecific antibodies. There's a variety of different ways that we're going to attack it when it's first diagnosed. There's minimal residual disease testing. I think we'll have a better grasp on ways to monitor if you're in remission and through treatment. And then I do think eventually one day we get to a point where there's an mRNA vaccine for every type of cancer, and maybe it's even customized to you specifically, and it's going to prime your immune system to fight the tumor cells when they reemerge, if that mutation reemerges, and hopefully you'll clear it before anything bad happens because your immune system is already ready to perform that task. So I think a third.
All right. Good. Well, we'll make that a recurring theme. I think we've all, probably everybody, underestimated how AI models and now the applications we're going to develop and the speed at which they're going to develop. So I think from an investment point of view, it makes sense to look for other things that are having something like that kind of dramatic impact. And I think therapies against cancer is, certainly, if we made a list of 5 things to focus on, I think therapies against cancer would be one of them. Mm-hmm. And maybe in the next couple of weeks, we'll try to, the three of us will walk around and think and do some internal discussion on if AI is one and cancer therapies are on the list, so we got 2, what are the other 3? And I think that's useful to do in a situation where we have all this macro stuff going on and a market that, stock market, capital market, whatever we want to call it, that's kind of, doing well to stay even. Look for the trends that can make a huge difference between what something's worth now and what it might be worth 3 or 4 years from now. So we established that as a challenge for the 3 of us. In the meantime, we're 6 or 7 minutes over, and everyone be well and stay healthy in the coming week. We will be here exactly 7 days from now. Thanks, everyone, for listening. Take care.
The views expressed on this podcast are the hosts alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the hosts nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to and no reliance should be placed on the fairness, accuracy, timeliness, or completeness of this information. The hosts and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future and may or may not hold positions in the securities mentioned.